That's right, folks. You know we were excited about Netflix earnings, and let's just say we've got a little bit of a Netflix nightmare right now. Nearly 20% down is pretty wild. Nearly 20% down. It's carried over into the pre-market a little bit. I think it will level off today, so keep that in mind. Where does that put us with this stock? Well, there's a lot to consider. Over the last year, the stock is down pretty hefty, frankly. You'd look at January 2021. This thing was a $579 stock. Now, trading at $400 after this massive downward move. This is a stock that has been absolutely terrorized over the last, really just over the last month and a half. You can kind of see where it was. There was, they had a great year last year, all things considered. Prior to this, they were up a good nearly 20%. And since their peaks following that at a point of nearly $700, or really it did reach $700, I'm sorry, it reached $700.99. Since then, now it is at a 52-week low. So it has reached its 52-week high and its 52-week low, all within the span of a month and a half. It's pretty crazy, folks. And if that's not just how wild the market is right now, it is a great personification of how crazy it is. So again, we're seeing the tech stocks that have performed so well over the last 5 years, really the last 10 years. We're seeing a little bit of a shift out of them, and you can see it over the last 5 years. Still a great performance, but after this big downward movement, we're going to be seeing it really close to up only around 150%. So it's going to be a massive downward move as a result of this. So keep that in mind. It's kind of crazy to see that. But let's look at these earnings and see why it is the case. One thing I've mentioned every time, you always have to be afraid of Netflix. It's just the subscriber numbers. Look, that's all that Wall Street focuses on right now. It doesn't matter what the company does. You've seen them continuously, even when they've seen user issues, grow revenue by steady, great rates, actually, and even profitability. And they've been doing that by raising fees and cutting costs in other aspects, too. So you can see with a lot of remote work, too, that's helped them in terms of costs, actually. But let's just look and see what's going on. So from a GAAP EPS standpoint, $1.33 beats by 50 cents. Don't make fun of the bedhead, by the way. Look, we do this right after waking up sometimes. We are dedicated to the craft. So massive beat in terms of a profitability standpoint. Really massive beat, which is good because it wasn't actually expected to be all that high of a number this quarter for some reason. So it looks like a little bit of a low ball. The revenue, though, was in line. Still up 16% year over year is very nice. $7.71 billion. In line, they typically beat, so that's one thing you got to consider there. Operating income came in at $6.2 billion, which is up 35% year over year. Very nice. And for the year, they're expecting an operating margin of 19 to 20%, and a free cash flow is expected to be positive for the future. They're expecting positive free cash flow from here on out, so we'll see what that's able to do. But let's see where the real story's at. That's right, here is the real story. It's going to be subscriber ads. The company had 8.28 million subscribers, which is actually very nice for them. And I'll show you here in the future, too, what that subscriber ads looks like historically, even from them. It's a really lofty number because they expected 8.5 million. I think their expectations were a little too high. Wall Street assumed 8.32. I think it's very high. And personally, I'm pretty impressed, all things considered. You consider the fact that they've got now over 220 million subscribers. To grow 8 million is pretty significant. I mean, it's pretty darn significant as far as what their total customer base even is. When you consider people that are borrowing accounts, I mean, to add that many it's pretty impressive in my perspective, because there's obviously a total addressable market, and it's a lot higher than that. But when you consider other factors like account sharing, free trials, it's not necessarily it's kind of hard to give a fair estimate of how many actual total addressable accounts are out there. But, that's one thing to consider. I still think it's an impressive number. Up 8.9% year over year. Last quarter came in at 9.4% year over year pace growth. There's a dog hair in my eyeball right now. I don't know how that happened, but it was blocking my vision. So, operating income did fall by 34%, as I mentioned. The profitability was quite a bit under last year's. I'm curious what that looks like. I'm not sure what that looks like, but we'll look at the net income lines, obviously. Given a larger content slate, that's what they're saying in terms of profitability, which makes sense. Obviously, you have to pay for quality content if you want to. You talk about things like Squid Game and the cost of keeping up in this business. It's very expensive. To keep up in the streaming business, you need really good originals. Disney spent over $200 million on a season of The Mandalorian. I mean, this is a full-fledged movie, very high-budget movie that they made into a TV series. So, streaming series. Sorry, I don't know if they're called TV series anymore. So, you have to spend a lot of money to keep up with the content that people want to see, because the way you win in streaming is having a lot of content and having good originals. Because if you have the same content everyone else has, because you can't get the unique rights to it, who's going to get you? I mean, if you don't have any unique content, no one's going to be interested in your service. So, it comes with a lot of increase in costs, so keep that in mind. U.S.-Canada ads were 1.2 mil, which is the strongest growth since the early days of 2020. That is very much true, because you've actually seen some quarters they've declined in U.S. and Canada. Still overcoming a little bit here. A little bit froggy in the morning, Asia Pacific 2.6 versus a year ago 2. That's nice. Latin America 1 million versus 1.2 a year ago. Nothing crazy. EMEA came in at 3.5 million versus 4.5 the prior, but still quite an increase there. Very nice to see. Free cash flow went sharply negative. To negative $569 million. That's pretty concerning, all things considered. You'd like to see the free cash flow look a little bit better. But we'll take a look at the balance sheet and see how that impacted it. So, for the first quarter, it's forecasting 2.5 million net ads. So, look, let's just be clear. I think that's part of our issue as well. All that matters is subscriber growth for these people. I don't know why. It's not even a fair metric. If they're able to continue to grow average revenue per user, it doesn't really matter the subscriber numbers, in my opinion, as long as they keep them steady. But Wall Street's it's a fickle beast, especially in this market. Very fickle. So what can we see? Let's see. So from a revenue perspective, it goes all the way back to Q4 2020, a full year's worth of quarters, and you can see how they've been able to grow revenue, and you can see the revenue forecast growth for the next quarter. Not quite as high as they did this Q4 into Q3, or Q3 into Q4, I should say, but it's not bad at all. $200 million growth is nice. It is only representing a 10% increase, so again, you see growth rates slow down, and they will. There's, again, as I mentioned, there's a total addressable market. It's all they can reach at some point, and the growth's going to slow down. It's not going to be high double digits forever. It just can't be. It's not possible. Operating income, as you can see from that perspective, really bad quarter, and that's just how it goes when you're spending on content. Next quarter, obviously, lesser of a slate in terms of content. Still expected to be under the Q1 2021 numbers. Curious why that is, but wouldn't like to see that necessarily. Terrible operating margin this quarter. You see, from a net income standpoint, really, really bad quarter, but usually Q4 they spend a lot more, so that's kind of where you see that. And kind of low expectations for Q1 2022, honestly. I don't necessarily like that forecast there. I'd like to see it higher, obviously. Not necessarily. I mean, preferably year over year. You'd like to see that growth too, but this is quite a decline year over year. $400 million less in net income expected. I don't like that. from a streaming memberships here, this is what matters. You can see the net adds and why it had kind of a rougher year towards the start there. 1.5 in Q4 only. Now expect the 2.5 in Q1, which they had at 3.9. And it's only an 8% growth. So this is going to be one of the worst quarters expected in a while, and that's off the forecast. So if they hit those numbers and can beat them, that'd be nice. But if they don't even hit these numbers, this stock's going to be in for a rough time. Let's be clear with each other. So yeah, that's about all I think is worth noting there. Nothing crazy. You see the global net adds by quarter forecast versus actual. For the most part, they typically beat, but you've seen some misses here. Q1 2021 miss, Q3 2020 miss, Q3 and Q2 2019 misses. That was a really bad year for them, all things considered. People were talking a lot of doom and gloom by then. But you saw Q1 2020 massive overly hit there, but there's a lot of reasons for that. And Q2 2020 massive adds as well. But overall, still positive, and hopefully you don't see a time in which that's negative. So weekly paid net adds year to date. Obviously, you see overall 2022 so far the forecast. Sorry, is pretty light. And again, part of it still is a reaction of 2020 being so large, but you would have expected, because 2020 was so low, you would have expected Q2 2022 would have been more towards the middle there, as it kind of leveled out last year, but it didn't. They're expected a little bit lesser, so that could be a concern for the future, obviously, of this stock, trading at such a high multiple. Google searches. Look, does anyone care about search? I mean, I don't personally care, but here they go. They're going to flaunt. Obviously, Squid Game was up there. Bridgerton. Don't even know what that freaking means, but it sounds like some British bull crap. We don't care about it, okay? Cobra Kai, kind of a banger. Let's be clear with each other. No one wanted to watch Sweet Tooth. Don't even lie to me. No one was watching that. No one was watching that. I'm just being honest with you. No one was. So let's be honest, okay? Long-term stock price performance. Why do they mention? They typically don't have this on there, but there's a reason for it, because they knew these results weren't going to be satisfactory. Obviously, massively beating the benchmark when you look at anything long-term. Massively beating the benchmark. Last year, though, pretty darn rough. Definitely not beating that cumulative return. Massively beating the benchmark as well. So you got that going for you. I don't know. They normally don't add that on there, so that's kind of, I think that's a little petty of them, but that's okay. I mean, we get it. We can look at the stock price history. I mean, that's something we can do. Here's the balance sheet. Total current assets at $8.0 billion. That compares to $9.7 billion of a year ago, so definitely a decline here. The cash position has decreased quite significantly, frankly. Content assets, it looks like that's where some of the spending went. But you see overall total assets did rise, and that's mostly because of this content line here, 44.5 compared to 39.2. So there's a growth in assets. Now with that, obviously, do we see an increase in liabilities? I think that's certainly possible when you talk about that terrible free cash flow line. Total current liabilities at 8.4 compared to 7.8. Not that crazy. Total liabilities in general at 28.7 compared to 28.2. Not bad when you see shareholder equity has increased 15.8 billion compared to 11 billion. That's nice. The balance sheet's actually in good shape for a company that's seeing some concerns, maybe you could say, in terms of that. But that's okay. The streaming content obligations, worth mentioning too, 23 billion on that as well. So you got to consider that as a negative part of them as well. But looking back at the stock, 200. Well, actually, this is not accounting for today's drop yet. So the market cap is shrinking by 20% off of this number, which is crazy. It's crazy to think about that. So this is going to be sitting around right around $180 billion market cap. P ratio, it's going to fall significantly down to like the 37% range. Or 37 range. Look, this is a stock that is still very, very highly priced. It's very highly priced, and I hate to say that, but we're going to be talking about off of full year revenue, as you can see here, which we'll pull up real quick. It's worth bringing up. So for the full year, right around or really right around $30 billion. I don't remember what the full line was. I know it shows on here somewhere, but right around $30 billion in revenue. Still trading in a market cap over 180 billion. It's not cheap, and the PE ratio obviously means it's not cheap. Also, when you're talking about the net income, kind of not good line. I mean, it's a not good line, which also that I should have considered that impacts the PE ratio too, because this was kind of a rough quarter. So actually, it might not fall down as much as I anticipated there. But look, I think this is a dirt cheap place to buy Netflix when you're talking about a 10-year horizon. But I do still think there's going to be a lot of turbulence in the next year, and I don't think that goes without. I think that goes without saying. Look, it's going to be rough. Long-term call options on this, though, when you're looking a year out, I like it if it stays at this $400 level. I really would consider getting into a long-term call option strategy with this stock. I think it could be really good for you. That's what I got for you. Hope you have a good one.